China's property empire just isn't cracking, it's crumbling into a $60 trillion black hole that's sucking the life out of global growth and draining global liquidity. And while the political elites in China pump headlines of easing measures, they're secretly panicking. Now, the truth is this slump is accelerating deflation worldwide. It's going to force factories not just to slash prices, but also jobs. Now stick around because I'm going to flip your worldview on why this distant crisis in China is your imminent financial emergency and what you need to do right now to shield yourself before this wave hits right here at home. And tonight's show is brought to you by Focus Graphite. You can find them on the TSXV and symbol FMS and on the OTCQB and symbol FCSMF. And they've secured up to a $14.1 million in government funding to advance their chemical-free purification technology for next-generation batteries and aerospace applications. And right now, graphite is hot. This is one you don't want to miss out on. Stay tuned to the end of the show. Check out the pinned comment or description for more information. Now let's dive right into the heart of this crisis and what's got Beijing scrambling. Because the value of new home sales from the 100 largest property companies stood at about 253 billion yuan. This is about 35.6 billion in US dollar terms, representing a 41.9% drop from a year earlier. And this is after 4 brutal years of straight declines in home sales. And this is all happening despite repeated rounds of stimulus that have done zilch to stop the bleeding, as I predicted. Now, this isn't about tweaking policies. That's not the issue. This is a symptom of something far deadlier. Because the world's second largest economy is teetering on the brink of a recession, with the labor market there souring faster than spoiled milk. Now, the country's new home sales by area may decline another 15% from their current level before the sector stabilizes. That's from Lulu Shi, the director at Fitch. And that's really optimistic because China's economy relies heavily on global demand to fuel its growth. And as we discussed yesterday, those cracks in the global money market system that are draining liquidity worldwide, well, if that liquidity crunch hits its full force in China, a mere 15% drop will be child's play compared to the chaos ahead. Now, calls for further policy support for the residential market have grown as home price declines accelerated, suggesting developers still rely on price cuts to encourage sales. And that's part of the problem here. They've overbuilt a mountain of unsellable homes, and that's fueling a vicious downward spiral. But here's the real kicker. If these homes don't sell, and I don't think they're going to, we're staring at billions in dollars in losses that will cascade straight into China's already wobbly banking system that's starved for liquidity and desperate to get it. However, the prospect of a strong easing package is growing dim after Asia's largest economy expanded faster than expected in this third quarter. But don't be fooled. That expansion, it's just a house of cards that's about to topple. And as we're about to unpack, Beijing's repeated failures to halt this real estate price plunge is just the tip of the iceberg. Now, let's peel back the layers on why this property meltdown is snowballing into a full-blown economic nightmare. Because China's factory activity slumped for the longest streak in more than 9 years. The official Manufacturing Purchasing Managers Index fell more than expected to 49 in October, means it's still in contraction, suggesting activity has dropped the most in 6 months. And not to be outdone, new orders shrank the most since 2023 as demand took a hit from trade barriers amid weak sentiment at home. So what you're saying is this dual whammy, it hit hard. Because what we're facing is export demand in China is evaporating amid global slowdowns and trade barriers. And domestically, the housing collapse is gutting the manufacturing sector from the inside out. Now I want you to think about it, because in general, fewer homes sold means less demand for steel, appliances, construction gear, and it creates a vicious downward spiral. Now here's a proof. I want to take a look at some U.S. data here. We're going to look at new residential housing starts against industrial production. That's shown in red. And I want you to see this clear-cut relationship because as housing starts go down, as you can see in blue, what happens? Industrial production falls right alongside it. And you can see that throughout the cycles and the risk right now. This just isn't a China issue, but here at home, we're seeing housing starts head lower, and that means industrial production is going to go right down with it. Because the problem we're facing here at home is our builders are sitting on the largest inventory overhang since the global financial crisis. But what about the services sector that everyone said would prop up the global economy and turn manufacturing around? Well, in China, it's at stall speed. The global manufacturing measure in construction and services inched up to 50.1, but under 53, you're still in contraction. And this is why stimulus is fizzing out, because the economy is contracting faster than Beijing can pump money in. This is leading to vanished liquidity and jobs right alongside global demand. And so, as we've talked about in previous shows, where factories falter, services crumble next. And for Beijing, this spells a deepening deflationary trap when they're unlikely to be able to dig out of. But the situation gets worse. Let's turn to China Vanke, because they just reported a $2.3 billion loss amid sales slowdown. So now you're seeing it happen in real time. These hemorrhaging balance sheets of these property developers are going to spill right over into the banking system, as I predicted. And what that's going to do is amplify that liquidity drain we flagged earlier. Now, the builder still has about $10.8 billion if you want of onshore debt maturing until the end of the year. The firm's biggest maturity wall will be next year, when about $24 billion yuan of onshore public bonds and loans come due. So what they're facing, and this is the same situation as the global economy, is there isn't enough growth to service all the debt. And that's the core of this brewing crisis. And again, we can take a look at some U.S. data here, and we can drive this home. Let's take a look, because now we see housing starts overlaid against the delinquency rate on consumer loans. That's shown in red. And you can see as housing goes down, well, the demand for workers and demand at the factory level declines. And what happens? The delinquency rate rises. And you can see this relationship happen going into the financial crisis. It was happening right up to the pandemic, and now it's happening again. Because as you can see in the chart, as buyers vanish, starts plummet, jobs evaporate, and delinquencies morph into outright defaults, and that's mirroring what's unfolding in China and potentially echoing here if trade tensions continue to escalate. And this contagion isn't confined to residential real estate. In fact, commercial property, I think, is a canary in the coal mine, signaling broader pain not just for banks, but the global economy. HSBC Holdings, the largest bank in Hong Kong, warned that the city's commercial property sector continues to face downward pressure after bad loan provisions jumped this year. Bad loan provisions spiked to $700 million from $100 million last year, which reflects higher allowances for new defaulted exposures and the impact of an oversupply of non-residential properties. So you have two real issues here. You have chronic oversupply in China-linked markets, and this global work-from-home hybrid work schedule has gutted the demand for office space all over the planet. And this squeezes banks. And why? Because they lent against these buildings at peak prices. And this is forcing them to set aside more money in reserves, and that means less money to lend. Now, remember, we talked about all that stimulus cash the PwC said they're going to inject into the Chinese banking system. I said that it was all going to lead to the purchase of government debt, and now you can see why. Because the banks don't want to lend. They're not in a position to lend, and that means they're going to choose safety over lending activities. And here's the proof. Let's turn to new privately owned housing starts, still in blue against commercial industrial lending in red. And you can see very clearly where the housing market goes, lending falls. And that's a big problem here, because what we're facing right now is housing starts around the world likely to decline. For banks, it means more pressure on their balance sheet, and that means there's going to be less lending. And there's some big knock-on effects from this, because as you can see, weak housing demand and souring loans, it triggers that lending contraction. And that leads to destroying the money supply. It craters jobs and turns disinflation into outright deflation. Now, if you tie this all back to that money market liquidity crunch we discussed yesterday, you can see why it's clear that things are going to get worse. But hang tight, because I'm going to reveal the steps that you can take right now to fortify your finances before the storm hits. So far, we journeyed through the cracks in China's property empire, the factory shutdowns, developer bloodbaths, and the looming bank contagion. But without a seismic shift, like a $20 trillion yuan of direct household transfers, this slump is going to drag China's growth below 4% into 2026, according to Fitch. But think about this. They're exporting deflationary chill that could trigger a global slowdown. And that, my friends, is the best case scenario. But here's your payout, because this distant crisis, well, it's a wake-up call to act. Now, you want to shield yourself by diversifying out of China-heavy stocks and indices. Pivot to U.S. Treasuries for safety. How about non-exposed tech like AI plays, or even commodities like graphite amid export curves? Now, for jobs and savings, you want to build an emergency fund covering 6 to 12 months. You want to lock in your high-yield savings accounts and pay down your high-interest debt. Now, if you follow this, you're going to come out of the storm stronger than ever. But let's talk about the opportunity with Focus Graphite. They're a sponsor for today's show. Again, you can find them on the TSXV under symbol FMS and on the OTCQB under symbol FCSMF. Again, everything you need to know in the pinned comment and description below. because they're a game changer in the world of critical minerals. They're developing 2 massive high-grade graphite projects in Quebec, Canada, and their technology is set to shake up defense and clean energy. With China tightening exports on graphite and battery materials, North America needs secure supplies more than ever. In focus, they're stepping up big time. Now check this out. Their Lac Knife project is North America's highest grade natural flake graphite deposit at around 15% graphitic carbon. A fresh feasibility study shows a 27-year mine life, pumping out about 50,000 tons of concentrate yearly with a net present value of over $500 million and a quick 2.8-year payback. That's low-cost, high-quality stuff that's perfect for batteries and military gear. Then there's Lac Testapisca, one of North America's largest graphite resources with an indicated 59 million tons at over 10% grade. And a bump in those numbers is coming soon. These projects put Focus way ahead of its peers in grade, meaning better efficiency and premium products that crush the competition. And what's super exciting, Focus just landed up to $14.1 million from Canada's government to build a demo plant for their green, chemical-free purification process. It hints at around a 99.95% purity, even nuclear grade at just under 100% without those nasty acids. And that's going to slash environmental impact in a big way. Plus, with U.S. tariffs on Chinese graphite skyrocketing to 720% and NATO calling graphite a very high risk for defense like fighter jet and submarines, Focus's North American supply is a total win for security and sustainability. Now get this, they've already proven their graphite in real hypersonic rocket launch for aerospace, and early battery tests show a 26% boost in cathode density. Their patent-pending silicon-enhanced technology is cranking up battery performance with more grants like $300,000 from IP Ontario fueling the fire. And while peers trade at higher market caps, Focus's superior grades and tech edge mean huge growth potential. They're nearing permits, eyeing resource upgrades in early 2026, and lining up partnerships. Talk about momentum. Now keep an eye on Focus Graphite. Again, you can find them on the TSXV under symbol FMS, on the OTCQB under symbol FCFMS. And this is one you definitely want to put on your hot list because with our high-grade projects and government backing, the sky is the limit. Now, as always with any company we feature on the show, you're under no obligation to purchase their stock. Be sure to do research before placing any trades and use your risk control levels when you do. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.